and welcome to the lecture series on insurance. We are here dealing with the subject Principles of Insurance, that is IC01. In the last lectures, we have dealt with the first chapter on risk management. Now in this lecture and in the next few, we would be dealing with the second chapter, that is the concept of insurance and its evolution. Consider this scenario. It was an ill-fated evening for Raghu. That evening, he was travelling home after a hectic day in office. He was running late and was speeding to get home on his motorbike. The road had no adequate streetlights. He did not notice a truck approaching him at great speed, but it was unfortunately too late for him to change the lanes. The truck ran over him. Unfortunately, he couldn't survive the accident and was declared dead when he was brought to the hospital. Now, Raghu was survived by his wife Gunam and two school-going kids. Gunam's life was shattered since Raghu was the only breadwinner in the family. Fortunately for her, Raghu had bought a life insurance policy which proved extremely helpful at this critical juncture. Although Raghu's untimely death can never be forgotten by Raghu's small children, his old parents and Gunam, they can now manage to maintain more or less the same standard of living. Gunam has taken up a job in a nearby private firm and has bought an insurance policy for herself. Now Raghu's motorbike was covered under the motor insurance policy. Although the bike was purchased on loan from the local bank and was totally damaged in the accident, and the bank had approached Gunam for the balance payment of the loan amount, since there was a motor insurance policy, the insurer paid the value of the bike to Gunam and the loan could be paid back. In a sense, through this scenario, we understand that even though Raghu had died and left a vacuum in the surviving family members' lives, because of the insurance system, the family could get some financial assistance after his death. They could pay off his debts and also become financially secure. This underlines the fact that life is uncertain and one has to be prepared for any contingency. Here lies the importance of insurance. Now let us look at risks in different settings and its implications on insurance by analyzing three situations. Imagine that you own a car. Think that some of the risks associated with your car are the risk of damage to the car due to any unexpected event, the risk of a car accident and injury to the driver, the risk of the car being stolen, the risk of the car running over someone on the road causing injury to and the legal liability on the owner of the car to compensate the injured. Now consider another fact situation. Imagine that you have a family of 4, your wife and 3 children, and you are working with a company. Some of the risks related to the job include the risk of untimely death due to some unexpected event or loss of income for the remaining working lifespan. And in case of untimely death, the responsibilities that are left behind, such as children's education, children's marriage, home loans, etc. The risk of falling ill and loss of income for a temporary time period. Then the risk of accident, temporary disability, or loss of earning capacity for the remaining work life. Now take another situation. Imagine that you own a business. Think of some of the risks that are associated with the business, such as the risk of damage to the premises or machinery due to floods, earthquakes, etc., the risk of damage to raw materials or finished goods, the risk of theft of stock or money. Now, do all these risks worry you? You need not panic, as insurance can provide a cover against all the risks. For example, in the first situation, motor insurance can provide you with a cover against risk related to your car. In the second situation, Life insurance can provide you a cover against risks related to your life. If you fall sick, health insurance provides you the medical costs. In the third situation, fire or property insurance can provide you with a cover against risks related to your business. So, to protect yourself from the risks associated with the assets and to continue to enjoy the benefits from it, you need insurance. Now, what are assets? Assets are economic resources. Anything tangible or intangible that is capable of being owned or controlled to produce value and that is held to have positive economic value is considered to be an asset. This is a fairly simplistic definition, except that the word tangible means something that you can touch or feel. Intangible is something that you cannot touch or feel. Now, tangible includes furniture, building, laptop or machinery, etc. And intangible assets would include your intellectual property rights, like patents, copyrights, etc. Assets represent ownership of value that can be converted into cash, although cash itself could be considered as an asset. The business of insurance is related to protection of the economic value of the asset. An asset is valuable to the owner because they get income or benefits from it in the form of comfort or convenience. Recollect the three scenarios that we had discussed. In the first scenario, the owning of a car is an asset does not give the end user any monetary value, but it provides the owner comfort and convenience in transportation and therefore has some value to the owner. In the second situation, a human life is an income generating asset. And in the third situation, the business owner can sell finished goods and generate income. Here, business is the income generating asset. This includes the premises, the contents of the building like machinery, raw materials, finished goods, etc. Therefore, in all these three situations, the owner would be interested in continuing the enjoyment of the benefits from these assets. Now, more on this in the next lecture. Bye bye. Stay safe.